right, we are live. Welcome back, everyone. If you're new here, welcome. Good morning. Welcome back to the stream. Quick audio check before we get into the madness. If you can hear me, type 1 in the chat, please. All right. So, this is the final Federal Reserve meeting of the year. We have a possible rate cut. The market pricing is almost perfection, and AI stocks that have gone parabolic. We have indecisive sitting near highs, but underneath there's a lot of tension. If you open social media, everyone is confident. You look at the options market, everyone is confident, but you look at the bond market is nervous, and there's a lot of tension. So, tonight, I want to take all that noise and turn it into a simple, clean roadmap. Across the stream, here's what we're going to break down together. Number 1, what the Fed is expected to do, and what the market has already priced in. Number 2, how this decision will ripple through the indices, not just tech, but financial, small cap bonds, and even commodities. So, number 3, the real reason this rate cut matters, not because of the cut itself, but because of what it signals about the 2026 growth, earnings, and liquidity. Number 4, the watch list. Who stands to win the Fed turns dovish, and who falls apart if Powell hits at caution. But before we do any of that, let me get a quick read on the room. If you think the market goes up after the Fed meeting, type 1. If you think we sell off, type 2. If you're neutral or just watching and learning, type 3. Let's see what the sentiment is right now. Okay, I see some ones, I see some twos. So all right. Interesting mix. More bulls than bears tonight, but definitely not anonymous. That's good. A room with mixed opinions is a room that trades well. Okay, let's slow this down and talk about what's actually at stake. One moment, I'm fixing my stream. So let's slow this down and talk about what's actually at stake. Tonight, the Fed is widely expected to cut interest rates by 0.25%. That part is not the event. The market has priced it in. The future market has already priced it in. Your charts have it priced it in. The real event is the tone. How many rate cuts do they guide for the next year? Do they see weakness in the economy? Do they feel confident enough to support growth? Or do they stay conservative and signal fewer cuts? Here's the crazy part. A rate cut can be bullish or can be bearish, depending the tone behind it. A dovish tone equals liquidity, support, and risk appetite. A cautious tone equals fear of slowing down, fear of tightening credit, and fear that the Fed sees something the market doesn't. If you think the Fed is seeing something that we aren't, then we are expected to see a more cautious tone. We also need to look at the context. AI stocks have run far, really far. Some of them deserve it, like Microsoft, Nvidia, Amazon, but others, they are priced as if they already won the entire AI future. Oh, it's not good. Small caps have been lagging, banks have been struggling with margins, consumer credit companies are flashing early warning signals. Office real estate is still office real estate. So depending on what the Fed says tonight, we could see tech explode or reverse. Small caps finally catching up, or they might even sink lower. Bank stabilizes or get crushed, and defensive stocks start rotating higher. Speculative AI names get wiped out or take off. This is why the decision matters, because the market is stretched and stretched markets react dramatically. So there is something, let's open this. So put the odds of another 0.25% point cut in the Fed's benchmark rate at 88%. So there's something many traders forget. The Fed doesn't just influence interest rates, it influences psychology. People feel richer or poorer depending on Powell's tone. Money gets more aggressive or more defensive based on a single sentence. Funds reposition instantly. Options dealers adjust instantly. Market liquidity shifts instantly. Tonight is a sentiment reset, a tone reset, a liquidity reset. So here's what we're going to do next. We're going to break down what exactly the Fed is expected to say. Then we're going to look at the winners if the Fed is friendly, the losers if the market flips, and how to position yourself without gambling your account on a headline. By the end of this live stream, my goal is for you to walk away with clarity, not predictions, clarity. A plan, levels to watch, names to avoid, and names to focus on. So, get your charts ready, open up your watch list. Let's dive into the main headline. What Powell says tonight will decide where money flows for the next 2 to 6 weeks. Guys, as I said, tonight is not a normal night. We have the Federal Reserve, a possible rate cut, AI stock that have run far away, and a market that looks strong on the surface but has a lot of hidden risks underneath. In this stream, I want to do 3 things with you. Talk about today's main headline, the Fed rate cuts, and why everyone is so nervous. Break down how this affects the overall market, indices, sectors, and sentiment. Go through a watch list. Which stocks could benefit and which ones are in the danger zone if the mood changes. Before we jump into the charts, let's warm up the room a bit. So, first question of the night. If you are bullish on the Fed, and you think the market goes up after this meeting, type 1 in the chat again. I want to see again. And if you're bearish, then type 2. I want to see if you guys are still here. Let me see what you guys think. So, as I mentioned, before we jump into it, the real question is, how many cuts do they hint for next year? Do they sound more relaxed and supportive or cautious and restrictive? Is this the start of a real easing cycle or just one and done move? At the same time, this year has already been volatile. Tech and AI have led most of the gains, Many stocks look expensive. Global growth is not very strong. So there is tension in this AI. There is tension between AI is the future and are we paying too much right now? Tonight, it's not just about interest rates. It's about liquidity, risk appetite, and whether the market can keep dancing or just sit down for a while. So, let's connect the dots. When the Fed cuts rates, borrowing becomes cheaper. That usually helps growth stocks, especially in tech. Money tends to move out of cash and into risk assets. But there is a twist. A lot of AI tech names are already priced in for perfection. Many of them are spending aggressively and the expectations are very, very high. If the Fed sounds cautious about the economy or hints that cut will be limited, those high-flying names can fall very quickly out of the sky. So, we get a split market. Some sectors clearly benefit from lower rates. Other names, especially overhyped, unprofitable, and highly leveraged ones, can be punished. This is why we need a winners list and a dangers list. Let's start with the potential winners. These are groups that usually benefit from lower rates and better liquidity. Big tech and quality AI, these are the big names, real cash flow, and real businesses behind the AI story. So, big winners, that's right here. Winners will, number 1, Microsoft. Number 2, Nvidia. 3, Amazon. Microsoft has strong exposure to AI and cloud and a huge balance sheet. Nvidia is still the key hardware supplier for AI, and Amazon combines consumer side with its cloud business. When rates move lower, the market is more willing to pay for their future earnings. If risk appetite returns, these are often the leaders. So, guys, if you're holding Microsoft or Nvidia or Amazon, type in the chat so I can see how many of you are in these big tech names. Let me know what you're following and how many of you are in the big winners. All right, so the next group, enterprise software. For example, Salesforce and other large business software companies. Their valuations depend heavily on future growth. Lower rates make that future look more attractive on paper. If the Fed sounds friendly, money often rotates back into high-quality software names. So, advertising and social media platforms. Then we have companies like Meta. When the economy feels more stable and financing costs come down, companies are willing to spend on advertising. Meta also invests heavily in the AI infrastructure, so Meta sits in a nice intersection. Advertising recovery, AI exposure, and still trading at more reasonable valuation compared with other mega caps. So, now, very, very important. Housing. When interest rates goes down, mortgage rates usually come down as well. Cheaper mortgages make it easier for people to buy homes. So, home builders like Linear and D.R. Horton and the broader home building sector can benefit early in a rate cut cycle. If the Fed confirms the rate cut and bond yields drop, the housing growth is worth watching. The housing group is worth watching. So another thing, small cap stocks. The smaller companies in the market have been lagging behind the big names. They are more sensitive to the real economy, more sensitive to interest costs, often more beaten down when investors are nervous. If the market believes the Fed is serious about growth and supporting growth, small cap stocks can play catch up in a big way. So, I like to keep an eye on the small cap index as both a potential beneficiary and the sentiment guide. Do you guys agree? Let me know. So, another thing we can watch out for, defensive and yield plays. There are also some defensive areas that can benefit. For example, utilities. When interest rates fall, high divided utility stocks start to look more attractive compared to government bonds. Gold miners are another example. If rate cuts weaken the dollar or push real yield lower, gold often gets a tailwind, and the mining companies can move even more. If you had to hold just one group after a dovish Fed, which would you pick? Big tech, small caps, or defensive names like utilities? Type in the chat, tech, small caps, or utilities. I'll give you a minute to type. I'm gonna have some water. Type tech, small caps, or utilities. Which would you pick if only one? So let's flip on the other side. I see some of your comments, but now we're gonna flip to the other side, the danger zone. These are the names and sectors that can get hit if the Fed sounds less dovish than expected, or the market finally says, okay, the AI story is great, but the price is too high. So, high story, high spending, and AI names. First group, the high story, high spending AI names and cloud names. Think about companies like Snowflake, Planeteer, C3 AI, Cloudflare, and a whole group of similar high-tech story tech names. I'm not saying these are bad companies. Many of them solve real problems and have real long-term potential, but they all share the same three red flags. First, expectations are extremely high. The market is pricing them as if nothing can go wrong. Second, their spending is heavy while profits are thin. A lot of these companies allocate huge amounts to R&D, sales, and infrastructure, which keeps margins under pressure. Third, their valuations assume perfection. Perfection executes perfect growth, perfect adoption for many years. And when a stock is priced for perfection, even a tiny miss becomes a big problem. So, when the market shifts from growth at all costs to show me the earnings, these names can drop very fast. So, we just saw a perfect example, Snowflake. It fell sharply after earnings, not because the business collapsed, but because expectations were too high. That's the risk I'm talking about. When liquidity tightens or sentiment flips, these high valuation AI stories are the first to get punished. Do you guys agree? Let me see. Next up, guys, regional banks. These are your mid-sized and smaller banks that focus heavily on local leading, small businesses, real estate, and community borrowers. And here's the important part. Rate cuts are double-edged sword for them. One on hand. Lower rate cuts can stimulate. So let me see here before I move on. I missed something. Next up, regional banks. These are your mid-sized and smaller banks that focus heavily on local lending, small businesses, real estate, and community borrowers. And here's the important part. Rate cuts are double-edged sword for them. On one hand, lower rates can stimulate loan demand. More people borrow, more businesses expand, and that's good for banks. But on the other hand, rate cuts squeeze their margin because what banks pay on deposit doesn't fall as quickly as what they earn on new loans. So their profit spread gets tighter, and that's the lifeblood of banking. Now, combine that with a Fed hinting at lower economic growth or risking credit risk, and these banks start feeling pressure very quickly. So for me, regional banks serve two roles in this market. They are risk indicator. If they weaken, it often signals stress beneath the surface, and there are a potential weak spot in a lower rate, slower growth environment. If the Fed sounds even slightly cautious tonight, these are the names that can flash red first. Let's go. One moment before I move on. Give yourself some time to drink some water. So, let me continue. If the Fed sounds even slightly cautious tonight, these are the names that can flash red first. Consumer credit companies, number one. Now let's talk about the big credit card and consumer finance names. Companies like Capital One, American Express, Discover, Synchron, all of them. These are stocks basically tied to one thing, the health of the consumer. If consumer starts missing payments, if credit card balances keep rising, if spending slows down, these companies feel that pain immediately because all that risk sit directly on their balance sheet. Rate cuts eventually help by lowering interest, but burdens and support spending. But that benefit takes time. In the short term, if consumer data looks shaky, these stocks can come under pressure very quickly. So, in a rate cut environment, I'm not just watching the Fed, I'm watching consumer credit trends. If those numbers weaken, companies like Capital One and American Express become vulnerable, even with lower rates. So, let's look into the second one. Airlines. Airlines are always a tricky sector to invest in. Unlike many other industries, they operate with extremely high fixed costs. Aircraft leases, maintenance, labor, airport fees, all of which do not fall even when demand slows. At the same time, their profitability is heavily influenced by two highly volatile factors: fuel prices and consumer travel demand. When fuel prices spike, margins disappear quickly. When travel demand softens, whether from economic slowdown or geopolitical tensions or health concerns, airlines feel the impact almost immediately. This makes the sector very sensitive to global uncertainty. Investors typically avoid airlines during periods of instability because the downside risk can accelerate fast. A small rate cut, while helpful for overall economic sentiment, does little to solve the structural challenges airlines face. Their problems are more cyclical and cost-driven, not something lower interest rates can meaningfully fix in the short term. Number two, office real estate is another area facing deep structural challenges. Yes, lower interest rates make refinancing easier and reduce funding pressure, but they do not solve the core problem: too many offices and not enough demand. Vacancy rates remain elevated in major cities. Tenants are downsizing, and long-term shift towards hybrid and remote work continues to reshape how companies use office space. Even when leases expire, many firms renew for smaller footprints, and a trend that keeps supply high and rental income under pressure. Finally, we have the overhyped micro-cap AI names, the tiny companies that rallied simply because they added AI to their press releases or investor presentations. These stocks tend to surge when liquidity is abundant and traders are in full risk on gamble mode. A catchy narrative is enough to push them up by 50 to 200% in a short period. But the problem is that very few of these companies have real revenue, real products, and real adoption. When the market shifts toward volatility, discipline, or earnings quality, these are the first names to get hit. Liquidity dries up, profit taking accelerates, and the lack of fundamentals become obvious very quickly. If you're holding any of these small speculative AI plays, you need a clear risk plan, defined exit levels, and the discipline to cut losses early. Guys, hope is not a strategy in this part of the market. Before we move into the Q&A session, let's walk through some technical setups on three important names: Nvidia, Amazon, and Meta. These stocks matter because they give us a good read on the market's risk appetite. When these leaders are strong, the broader tech space usually follows. When they stall, momentum often cools across the board. So, let's look at Nvidia. I'm on the daily chart now. So, these stocks like Nvidia, okay, let me just start here. So, let's start with Nvidia. Technically, it's looking constructive. Not perfect, but constructive. And I'm going to show you why. in a moment. So let's look at NVIDIA. NVIDIA recently formed a higher low around 173. Recently formed a new higher low at 173. NVIDIA, and which is especially what you want to see if you're looking for a continuation in an uptrend. Buyers stepped in earlier than before, which shows increasing confidence. So, however, we also saw the price break above the previous swing high at 182. Right. Previous swing high was at 182.9. This is important because it signals the momentum has shifted back to the bulls. The downturn sequence of lower highs has been interrupted. It's also closing above. This is another positive signal that the price has closed back above the 50-day EMA, which often acts as a medium-term dynamic support level. When price reclaims the 50-day, it usually means the demand is returning. So, what are the key levels to watch for NVIDIA? Support. As long as NVIDIA stays above the 173 right here, The overall structure remains bullish. A break below that level would tell us buyers are losing control. And for the resistance, but if you're long, you need to be cautious as the market price approaches the 192.57. This is the resistance zone. Why? Because that level has been rejected by buyers before. It's where supply tends to show up. If you can see here, this price has been rejected before. If it's where the supply tends to show up, if it falls there again, we could see a healthy pullback or a retest of the 182 to 185 area. So overall, strong structure, but approaching a decision zone. There's many ways this could go, so watch out. Next up, Amazon. I'll put Amazon. So Amazon has been ranging. Amazon has been ranging between the 236 resistance and 215.18 support. Let's see. And for the resistance, next, now let's take a look at Amazon. Unlike Nvidia, Amazon is not trending, it's ranging. A range tell us a lot about indecisiveness in the market. So, clear resistance at 236, which has been a very clear resistance zone. Every time price pushes into, let me see here. Every time price pushes here into the 236 zone, we see sellers stepping in and a momentum slowing down. Every time touches, we see back. Strong support at 215. On the other side though, we have strong support around 215. Buyers consistently defend this level, making it the lower boundary of the range. As you can see, we're in a ranging period. And as before, we noticed every time we go up, there's a sellback, 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 we go up, and sell back, we go up and sell back. And this is what's happening right now, but in a range position. So the recent the Amazon attempt to break above the 236 recently Amazon tried to break above the 236, which failed. We saw 5 consecutive bearish daily candles, which is a pretty strong signal that sellers are actively and willing to push price back down. As you can see here, push 1, 2, 3, 4, 5, and back down. So what this means going forward, with that kind of selling pressure at the top of the range, there is a high probability that Amazon will drift back towards the 215 support. It is a high possibility that we might end up back here at support until we see a clean breakout with a strong candle close above 236. Amazon is simply moving sideways. For traders, you either trade the range, so we sell near the top and then buy near the bottom, or you wait for a breakout. For long-term investors, this is just consolidation, not a trend reversal. So that Amazon is raised now at this level. So Amazon is now consolidating at this level. Ranging. It's ranging. And at this price, was rejected. Strong sellers. We are also seeing a head and shoulders pattern, so be cautious as we don't know what the next move will be. Now, let's look at Meta. I'll just put it here. Finally, let's take a look at Meta. The stock is trading around 653. Let's see. 665. Key level is the 600 and let's see. So the key level will be the 676. This is very interesting spot for a technical perspective. Right now, Meta is reacting to the 200-day moving average, which is acting as a dynamic resistance level. Institutions watch closely. When price sits underneath it, the stock often moves in a more choppy corrective manner. So the key breakout, the major level to watch is the recent high at 667 here. That's the line in the sand. If Meta can break above and hold. If it breaks and it can hold, it confirms a continuation of the recovery rally. If Meta fails to at the 200-day, it's likely to pull back or continue sideways. That would mean buyers don't have enough strength yet. If Meta breaks and holds above 676, that would be a very strong signal that institutions are stepping back in and that the uptrend is resuming. Let me quickly break down what caused Meta's sharp rebound over the past few weeks. Very straightforward, but very powerful catalyst. An influential analyst issued a highly bullish report with a big price target, emphasizing Meta's growing success in monetizing AI inside its ad business, especially improvements in targeting and campaign optimization. Meta won an important legal ruling against the FTC, removing the threat of being forced to break up Instagram and Facebook. Do you guys know about this? So, because Meta won this important legal battle with the FTC, that reduced a major overhang on the stock. The entire large cap tech space bounced strongly and Meta joined the move after becoming oversold in late November. Sector momentum helped accelerate the recovery. The bottom line, so with Meta, it all comes down to one thing. Stay below the 200-day EMA, expect chop, sideways action, or another retest lower. However, a break above 676 and hold, the uptrend continues and buyers take control again. So, alright, let's bring you guys back in, so I'm not just talking. In the chat, tell me this. One stock you are most confident in if the Fed turns out to be dovish, and one stock you are most worried about if the market sells off. Put both names in one message. I will give you a moment, then I will take a few comments from the chat and walk through how I would think about them in this rate cut environment. Alright, let's wrap up with a quick recap of everything we covered tonight. The main story is the Fed, the rate decision, the tone of the press conference, and what it signals for future cuts. Remember, the Fed doesn't just move markets with what it does, it moves markets with what it says. And tonight's message will reshape the next few weeks of price action. So, on the opportunity side, we highlighted several groups that tend to benefit when the market expects easier policy. Big tech and high quality AI names with strong cash flow. Home builders and anything tied up to lower mortgage rates. Small caps which love lower financing costs. Utilities and defensive sectors. Gold miners if the dollar weakens and yield falls. These areas can catch momentum quickly when conditions shift. Let me know if you agree. I want to see your comments. I want to see if during my live stream you didn't have the chance to ask questions. You can drop them now in the chat. It's your time. So, I see on the risk side, we discussed the pockets of the market that remain vulnerable. High story AI names with very high expectations and weak earnings. Regional banks that struggle with margin pressure. Consumer credit companies like Capital and Amex if spending weakens. Airlines, always sensitive to costs and confidence. Office real estate, still dealing with structural demand issues. And of course, the speculative microcap AI names, the ones that fly on hype and fall even faster when volatility hits. These are the spots where you don't want to be careless. So, stay flexible, trade what's strong. And as always, don't marry a narrative. Don't get stuck on what should happen. Watch the actual money flow after the Fed decision and trade what is showing real strength in real time. If you found tonight's breakdown helpful, hit the like button, share the stream with a friend who trades US stocks, and make sure you're subscribed so you don't miss the next live session. So, thank you all joining so much. I'm so happy you all joined. And if you have any questions right now, drop them in the chat. Or if you have future questions for the next slide, also drop them in the chat, what you want me to discuss. But once again, thank you all so much for joining. And I hope to see you in the next one.